So most people realize that their portfolio was fragile after already losing money. But there's few different ways you can look at the portfolio. So of course you can look at your risk tolerance and your age, and that would determine if you're going to tilt your portfolio towards risky assets, if you're going to look to have a balanced portfolio, or if you lean towards more conservative portfolio with blue chip companies, gold, bonds, precious metals, etc. But the reason I'm filming this video is because I want to look at different ways that you can construct your portfolio based on what is it that you want to achieve. So for example, in my case, when I was starting out, I understood straight away that I have a very high risk tolerance and that I'm a natural speculator. And what I mean by that is that I am completely fine by, being going against the crowd. So I had many examples where I would buy a stock, let's say it's a junior mining stock. So my sector of specialties, the sector I put most of my amount of energy and effort into would be commodities and precious metals. So things like copper, uranium, gold, silver, platinum, etc. And there's different reasons why I would invest or speculate into each of those based on what I want to achieve. But at the start of my career, I would certainly be very, uh, speculative. So I would be very happy to buy a stock, let's say a junior mining stock, and then few months later, the price of that stock would go down by 50%. And for most people, that would be absolutely terrible, right? And the problem really is the reverse psychology that most people have for some reason. Because really, as a competent investor, what you're looking for is you're looking for an asset and you're that fundamentally sound, and you want to buy it on the days when the market is very pessimistic and everyone hates that asset for for no reason, or if there is a reason, it's not a fundamental reason. So that's one way of looking at it. And then you want to sell it on the days when the market absolutely loves it. So everyone's excited, everyone's talking about it. Well, that's when you want to sell. But for some reason, people look at it from completely different perspective. So they buy a stock, and the price goes down, they get scared, they sell it, and then when the hype around that stock or whatever goes up, people love it again, then they feel they're inclined to buy it. But that's exactly the wrong thing to do. So as a speculator, I was more than happy to buy, uh, let's say, a junior company. The price went down 50% or more. I had situations where I was down 70% on an individual stock. And then from that, I looked at the fundamentals again. So fundamentals were still sound. So that made me happy. I can buy the same company I bought a few months ago, but at a 70% sale. Happy days, right? So that's sort of the mentality that you need to have, especially if you're speculating. And of course, with speculation, you need to create a bucket approach. So uh, you could have a bucket of 20 junior companies. Let's say you're focused on gold junior mining companies. So you create a bucket of 20 companies, and you create of 20 junior companies, 20 maybe mid-tier companies that could be like developers or whatever, and then you could have a list of 20. Well, usually in my case that was less. There's few blue chip companies that everyone knows about in the in the gold sector. And from there, even if you have a lot of losses, especially in the junior sector, a lot of companies could easily go to zero. But because you have the bucket approach, and because you, of course, believed in all 20 of them, at least you believe that the odds are higher than 20%. Or even if the odds are like 20%, if it goes your direction, the rewards will be absolutely unproportional. So that's sort of the speculator mindset. And that's what I would do very happily, and I still do it all the time. But that requires, I believe, natural. You need to be comfortable with being on your own in these situations where everyone hates what you're buying, and you need to still feel comfortable and sleep well at night. And that was the case with me. And then the other way you can do it is, of course, a more balanced approach. And then you can do a passive approach by investing passively. Maybe you do dollar cost average, where you put a certain amount of your dollars into a certain ETF or a certain company, whatever it can be, over and over again. And of course, you keep checking and revising your idea of why you invest in that company. Is everything still sound, etc.? But that's the idea. And there are different ways you can structure your portfolio. In my case, I would have some cash always for as a dry powder in case the market goes down. I can find even more appealing opportunities. But I especially at the start of my career or even now, I don't own bonds. I From my defensive perspective, that would be physical gold, physical silver, physical metal, and cash, of course, as well, because cash is king during recessions or during uncertain times. You always want to have cash, and you can see what happens with gold if the world gets uncertain. So I started buying gold when it was just over 1,000, and now it's over 3,000. So it went 3x in price. And that's my sector of interest. So that's where I understand all the dynamics. So one way of you looking at it is choosing a sector and really build your portfolio around your sector of interest, around the sector that you really, really understand. And then the other option would be, of course, to invest passively and do anything like that. Again, guys, none of this is a financial advice. So this is just me sharing my personal opinions, my experience with you. And then, like the most common strategy, old school, would be the quadrant strategy, where you literally draw a quadrant. You will have 25%, let's say, in real estate, 25% in stocks. You would have 25% in fixed income, so that could be like dividends or bonds, and you would have 25% in cash as well. That's sort of very balanced portfolio naturally. Of course, I believe in today's era of fiat money, money printing, the fact that money is not backed up by anything tangible like it used to be, which means that the government have complete monopoly on money printing and they control the money supply. And if you store your productivity in cash, in money, then you're always vulnerable to the government. That's why I love to own physical precious metals. It sort of balances that out. And because now the governments have complete opportunity to print as much currency as they can. That's what happened during COVID. They panicked. They thought we might enter depression. They printed all that money and they increased the M2 money supply. And because they increased the money supply, there's more money in the system, and therefore the amount of goods are relatively the same. Of course, with productivity does increase, but inflation dramatically overperformed because of the amount of paper that we printed. And as a result, we had that peak inflation of 9.1%, I think, in summer 2022 in US. But that's if we're using official numbers. If we're using, no, there's certain people who do their own calculations because a lot of things are not included into the CPI, especially the core CPI, at which the federal government looks when they make their decisions. They exclude like food, shelter, and things like that, which is just crazy, like the things that we actually use. But that's not the point. The point is that right now in the era of fiat money, you should not store your excess productivity, right? So you work, you're productive, you get paid in cash for like in paper, currency in dollars or euros or whatever. But that's not a good storage of value because you are not in control of how many those digits, it's digits really, or papers will be available in the future. And therefore, it's absolutely okay to get paid in cash. But then it's about what do you convert your productivity into? Is it going to be a company? Is it going to be precious metals? Is it going to be bonds? Whatever you choose. But just do understand that cash is risky. But with that being said, you should always keep a certain percentage of cash in case markets panics, something happens to the world, prices go down, and then you have unique opportunity to use your dry powder to scoop those bargains. So I think those are the main things I wanted to say. For example, in my case, my portfolio is not balanced, but because I love the sector, I really understand it. I understand that the world is moving towards towards so we want to electrify the world. We want to go carbon neutral. Well, that requires solar panels, wind turbines, electric grid, AI. It all needs minerals, and the sector has been underinvested for a very long time. So because of that belief, and again, I could be wrong in theory. I don't think so, because if I'm wrong, then the world will be completely different to what everyone expects. But if I'm right about all of these things, well, then it is okay for me to have a portfolio that's not balanced and leans towards these towards commodities pretty much. So mainly my portfolio would be commodities, cash, a little bit real estate, land, but not not much. So yeah, that's everything I wanted to talk about, guys. If you are interested, I have a how to get started free PDF. It contains a lot of great information. So if you're interested, please download. I put a lot of effort to create that file. And thank you very much, and I'll see you soon.